Well, it was an interesting week last week. The hawkish Fed repricing somewhat ran out of steam a little bit, allowing equities to gain a bit of ground. The S&P 500 notching its first weekly advance in 4 as Treasury yields pulled back just a touch across the curve, and the dollar rally took a little bit of a pause for breath. A busy week coming up. We've got Fed Chair Jerome Powell heading over to Capitol Hill, a huge jobs report due out of the US on Friday, and key central bank decisions on deck as well, from the Reserve Bank of Australia, the Bank of Canada, and Kuroda's last decision over at the BOJ in the mix as well. Plenty, as always, for Ryan Littlestone and I to discuss on the trade-off this week. Without further ado, let's get into it. Well, a busy week in the markets lies ahead, and I must admit I'm quite a happy bunny this week. Arsenal scored a last-minute winner at the weekend. Man United lost, Spurs lost. It can't get any better, can it, Ryan? What about the football this weekend?
Well, I'm more of a rugby man this weekend, Michael. I don't know what football is. I'm changing sports, and if that doesn't work, I'll move on to cricket and then snooker and darts. So, yeah, apart from the football, yeah, good weekend.
Good stuff. Sorry, mate, I had to get that dig in there. We've had so many years of hurt as an Arsenal fan. I've got to capitalise on it when I can. Without further ado, let's roll into Topical Thunder. So, Jerome Powell, he is off to Capitol Hill this week. I would argue that that is the main event of the week. It's going to be the last chance we get to hear from the Fed chair before the FOMC blackout period kicks in at close of play on Friday. And of course, this is Jay Powell giving his semi-annual Humphrey Hawkins testimony. It's going to be on Tuesday to the Senate and on Wednesday to the House. And I think, for me, I'm keen to see what Powell says in terms of how he reacts to the hawkish repricing that we've seen, well, since the last Fed meeting on the 1st of February. We know how significantly the market has moved. We've covered it at some length, and we're now obviously pricing in a terminal rate north of 5.5%, with just around about 10 or 12 basis points worth of cuts priced in for the second half of the year. I think, Ryan, what's interesting for me is obviously we've got the usual kind of focuses of how big is the move going to be at the next meeting, how high is the terminal rate going to be, how long are we going to stay there. But I think just looking at the kind of balance of risks and the balance of probabilities, I would say that the bar for a hawkish surprise from Powell on Tuesday and Wednesday is a very, very high one, given how far the market's moved, given how significant the repricing has been. And I just wonder whether we may see something similar to we saw actually at the last Fed meeting, where Powell's words are interpreted more dovishly than they're meant. We saw last time around, of course, when he said the disinflation process has started, equities went on a tear and the dollar rolled over. And I just wonder whether there's a risk, perhaps, of a sort of repeat situation this time around if we get similar language.
Yeah, I think you're right. You know, this is potentially a big event. I mean, in theory, it shouldn't be. He's just talking about what's happened over the last 6 months with monetary policy, but he's going to get questions off the politicians. They're going to want to know, are you getting your message across? But we've learned from the last few Powell outings outside of FOMCs, like Jackson Hole, that he hasn't really strayed from the script. He hasn't pushed anything other than what he's given at the FOMCs. So I think the market is going into this looking for something a bit more hawkish. And I think you're quite right. I think the bar is high at the moment, given what we've done recently. You know, 2-3 weeks ago, we were still pricing cuts this year. Now that's flipped on its head. The market likes to run from one side of the boat to the other. We're right on the hawkish side at the moment now. There is a high bar. If he doesn't deliver what the market wants, again, we're going to see a little bit of repricing. I don't think it's going to be the end of the story, but I would expect yields to come down a bit, the dollar to come down a bit before we roll into that FOMC orbit a week or so ahead of that.
Yeah, of course. I think that's a good point that you make in terms of Powell not deviating from the script too much. And I think you're right. I think there's quite a few out there who will be looking for a bit of deviation from that script. And if we don't get it, it could just turn into one big kind of buy the rumor, sell the fact idea. But sticking with the central bank theme, what are we thinking about the BOJ this week as we wave goodbye to Kuroda after a decade or so?
Yeah, well, it's a big week. We've got the RBA, we've got the Bank of Canada, we've got the Bank of Japan, we've got Powell, all the data coming, jobs data. So a lot of events to go under the bridge. And this one is going to be maybe specific for what's going to happen moving forward. We've heard from the recent Bank of Japan members last week, the week before, including Kuroda himself, that policy is going to stay as it is, easing. So the message has been, we're not going to do anything at this meeting. But he has pulled a rabbit out of a hat now and again. So, is he just going to wave goodbye with keeping it unchanged and over to you, Reader? Or is he going to drop something in perhaps that gives a reader something to work with moving forward? I think the risk is quite binary here. The market's going to move either way. If it's an easing policy, we're likely to see yen pairs rally once again because they keep easing to oblivion, even while there's inflation coming into Japan as well. And then the market's quickly going to shift to what Ueda does when he fully comes in. Is it going to be a change? So there's going to be a little bit of risk around this meeting. It comes, as we said, after Powell. So, who knows where dollar yen's going to be when we go into it. And it's going to be a bit spicy, I think, to find out exactly how he's going to leave exit stage left, shall we say, and Ueda enter stage right.
Yeah, exactly. I think it is an interesting one. I think I would almost liken it to when Draghi left the ECB, both in terms of, the end of an era in terms of policy, the end of some running jokes on Twitter, because we won't have those funny Kuroda memes to post anymore. But also in terms of the fact that I don't think he's going to go out completely silently. It's not going to be everything's on hold. Goodbye. I've done my time. Ueda, there you go. Here's a sort of blank canvas to start with. And I do think that there is the decent potential for a surprise actually this week. I think one thing that we've learned from the BOJ in terms of their meetings over the last quarter or two is when we're expecting them to do something, they don't do it. When every man and his dog is expecting nothing, they deliver a surprise, as we saw at the meeting in December of last year. And I just wonder whether that sort of adage is perhaps going to ring true once more. What I would say, just where I might disagree with you slightly there, Ryan, is that I think if he does do anything, it's going to be towards tightening policy, towards coming out of this uber loose policy era. So actually, I think the risks to the yen are probably to the upside going into this. I don't think there's much scope for a dovish surprise, but I do think there's some, perhaps negligible, but some at least, potential for a more hawkish outcome.
Yeah, definitely. Anything on the YCC, the market's already pushing that yield boundary constantly. The BOJ having to step in time and time again. So the market has been pushing this for a while. It's going to keep pushing it. It sees the Bank of Japan tightening. Question is whether they start indicating something on Friday or not.
Yeah, most definitely. Well, speaking of Friday, that leads us nicely into the non-farm payrolls number. We're almost getting quite good at this. It's like we know what we're doing with all these smooth segues this week. The February jobs report is due out at lunchtime here in the UK on Friday, 1:30 in the afternoon GMT, as per usual. Headline payrolls expected to rise by around 215,000. Now, some may say that that's a disappointment and that's a significant slowdown from what we saw in January. And well, yeah, you're right. But the January print was a blowout that just took all expectations and blew them out of the water. 517,000 jobs added. I think it would be very, very surprising indeed if that was not an anomaly. Obviously, we had a conversation at the time around how much of that came from seasonal adjustment and other factors. So I wouldn't be surprised if that is actually revised a touch lower when we get to the February report this Friday. Again, though, for me, it's not the payrolls print itself that matters. It's the readings under that, because what we're concerned about is inflation. How sticky is inflation likely to be, and how significant are the upside risks to the inflation outlook? And let's be honest, the number of jobs being created doesn't really tell you a lot about that. What does is the unemployment rate, which is expected to remain unchanged at 3.4%. And what also does is the average hourly earnings print, which is also set to remain unchanged, rising by 0.3% on a monthly basis. And I'm just I was weighing this up yesterday when I was sort of going through these slides and putting stuff together for the show today. And I was trying to think, where do we see a more significant market reaction? Is it on a beat or is it on a miss? And I think actually the more significant reaction and the greater degree of volatility out the back of the jobs number is actually going to be on a data miss, a higher than expected unemployment rate, a cooler than expected pace of job creation. Because if you think about the journey we've been on since the 3rd of Feb, when the January report came out, pretty much every man and his dog has jumped on this bandwagon that the US is going to have a soft landing. And if they haven't jumped on that bandwagon, they've jumped on the one next to it labeled no landing. And I think given how heavily tilted towards those two outcomes consensus is at the moment, and given how thus far at least data has been supporting that, if we get a tier one print that casts some doubt on those outcomes, we could see quite a significant move to the upside in equities and to the downside in the dollar.
Yeah, this is the biggest number of the month. It always is. The best economic data in the month for trading. It's wonderful. It's a complete lottery, and that's why we love it. Last month I thought it might come in a negative because of what we've been seeing in some of the prior data. Also, those seasonal factors, the poor storm weather that they had, which was combated by good weather elsewhere. But yeah, there is a two-way risk here. Either we get some of that washout of last month. If it goes negative, it's going to send the market loopy. And then we look at the details underneath. The participation rate is always important when looking at the unemployment rate. Has it moved because more people have come in or out of the jobs market? But, we could have a perfect storm. Powell could be super hawkish on Wednesday, and then we get a negative NFP on Friday, and the market's just going to be a washing machine. And how we finish up on Friday could be very interesting. But it's big data. We love big data. We love to trade big data, and I can't wait.
No, and I can't wait to discuss it next week. The other thing, if you're watching, get yourself involved with Ryan's Payrolls sweepstake, Forex Flow Live on Twitter. I'm sure tweet that out at some point during the week. Get yourself involved, and even if you don't think you can win yourself, just get yourself involved to see how badly Ryan and I embarrass ourselves with our guesses this month, given how far wide of the mark we were with the January number.
Let's get it on record. Let's get it on record now. What's your guess for Friday?
Oh, you've
put you on the spot.
You're testing me. I haven't thrown a dart at a dartboard blindfolded yet. I won't give you a full guess, but I reckon we're gonna get a miss. I reckon it will be
no, I'm not having that. Come on, I want a number.
No, we're out of time. We've got to move on. So what about the Fed?
Okay, well, I'm not going to let you off. I'm going to chase this down. Yeah, so it's everything that happens this week is going to lead us to the Fed and what happens at the next FOMC. You mentioned early in the show that we're going to have discussions on how big the hike's going to be potentially. Are they going to stick to 25? We've heard people like Mester, prompting that 50s might be back on the table or would be considered. For me, this is a bit like late last year. It's all about the dots. It's where the Fed now see the peak for rates. And that's going to move the market more than the increment. I think the 25 is nailed on. I don't think they're going to go at 50 unless we get some really huge data from the NFP and the rest of it this week and into the FOMC. But it's going to be that level of where rates are. We're currently, somewhere 5.25, 5.5% as the ceiling goes. If we get something dots well above 6, and I'm talking more than just 1 or 2, the usual Bullards and Kashkaris, that's going to really shift the market into gear. That's going to get yields rallying again. Obviously, the dollar's going to rally as well, and we may be hitting some significant levels in some dollar pairs. But that conversation about the size of the hikes, I think, is one to have after this next meeting coming up, because then if the data is strong, 50s will be back on the table, and off we go again with the pendulum and everyone getting more hawkish.
Yeah, exactly that. I mean, I think the other thing that I'm going to be paying very, very close attention to, and obviously the Fed is still a fortnight away. We've got the ECB sandwiched in the middle of that as well, which again, I'm sure we can get into a little bit more next week. But what I'm really looking at, just thinking ahead to that Fed meeting, is not necessarily the dot for this year, because I don't think there's much prospect of that changing too much. Maybe, as you say, 1 or 2 of the more hawkish members revising things higher. What I'm really interested in is that 2024 dot, because at the moment I think it sits at around 4.1% from memory. That may be incorrect. I haven't done my homework this week. But if we do see that revised higher, and I think we probably will, because every Fed member who gets within 10 yards of a microphone seems to utter the words higher for longer or something of that sort of ilk, and trying to signal that. But the dots aren't quite in tune with that yet. So I do think if we do see that 2024 dot move higher at the next Fed meeting, that's really what you want to be watching in terms of gauging whether or not we're getting a hawkish surprise, or whether they're kind of sticking with what they've given us previously, I think.
Yeah, absolutely. Because if we remember, one of Powell's lines has been he wants to see real rates across the curve into positive territory. You know, and they do that via the dots as one form of pushing the market into that. The market has only really the last few weeks started to take the fact that we may be going to their current ceiling. So yeah, if the curve, if you like, the dot curve, we should call it, get a copyright on that before them lot in Australia and Arizona nick it. The dot curve, we'll patent that. If the dot curve moves high, then yeah, you're going to get that push up in yields across the curve as well.
No, I think that's a great point. So with that said and done, let's move on to That's a Setup to give those in Melbourne and Arizona some charts they can steal. No, of course, it's all light-hearted. For those who may be unaware who we're talking about there, of course, we're talking about Chris Weston and Blake Morrow with the Trade Off Australia, which, if you haven't seen it already, do check it out. It is not quite as good as this production, but it is very, very good nonetheless, and I'm sure you will get some value from it. In any case, let's get into some charts of our own. I want to start with the S&P 500. This is something that, well, it's a chart that I've used a few times now. I've added a couple of lines to it since, so it's probably getting a bit messy, and I need to tidy it up a little bit. But I think it shows that last week was actually quite a decent week for risk assets. As I said in the intro, in the show intro, the S&P having its first weekly gain in 4. I think a decent chunk of that came as a result of the better than expected data, particularly the ISM services PMI print that we got on Friday. And also, I think that sparked, excuse me, frog in my throat. I think that sparked a bit of a round of short covering as well. And that is why we saw that significant move higher into the close on Friday. Just from a technical level, it's interesting to note that we bounced very, very solidly indeed off both the 100 and the 200-day moving averages last week, and that we're now back in the range that we saw pretty much the entirety of February, between 4,050 and 4,200. So I think if we can get above that 4,050 level on a closing basis, then the bulls are going to feel emboldened a little bit, perhaps to take us back towards the top end of that range. But at the moment, personally, I don't see much of a catalyst to force us through the top of that range at 4,200. So I think the bulls are in control for now as we've managed to reclaim those key moving averages and back in that range. But I think the gains are probably going to be relatively limited. What are your thoughts on that, Ryan?
Yeah, I think that chart says it all. You know, we had this move in February, and now, you know, in the space of a couple of days, we're sitting bang in the middle of it. I think you're quite right. The market is taking a bit of risk off the table from Friday. We saw, you know, yields doing the same thing. And that's because sometimes traders, you know, there is a big risk or a lot of risk events this week. You know, two times we've got Powell, we've got all the data, we've got all the central banks. Sometimes traders just look at the calendar and think, right, that's too much risk for me, so we're going to square up a bit. But in the wider point of where do stocks go, where does this one go, we've seen, even with the Fed turning more hawkish, it hasn't come off a lot. Yes, it's dipped down, but we're not talking any sort of collapse. The market is still unsure, I think, what it wants to do with the good data. Does it want to get behind stocks and the fact that we could get a better economy or no recessions out of the US? Or is it still in the camp, well, good data means, or bad data means easing and we go up? And good data means no more easing and all that QE stuff. So we're gonna move as well. So lots in the mix. This one is sitting poised delicately, as I said.
Indeed. What about your first setup, mate? Dollar Mex.
Yeah, Dollar Mex, a bit of a walk back on this one that we talked about a couple of weeks ago, I think. And we've had the big break in this one. You know, I think it was one of my plays of the day a while back that we already had seen the break of 1850 and to look at a retest. And that very week we got the retest, it held and it's moved all the way back down. 18 was the level I was looking at previously as potential support area. Maybe look for longs if it bounced off that level initially. It hasn't. It went straight through pretty much, and already we're seeing resistance against that level. So it's looking very much that the bears have got this one in control. Obviously, it's a big carry trade, so if you're short in this one, you're earning a ton of money on the MEX side, and the market keeps pushing and pushing. Technically, it's doing what it needs to do. It's breaking levels. It's then holding those breaks. There is a decent level a bit further down in the sort of 1760s to keep an eye on, but as we like to say in trading, the trend is your friend. So, shorts into this 18 zone still look good. Above maybe 1810, 1820, that's where things might look a bit different. But that big 1850 is the one to keep an eye on.
No, I think you're absolutely right. And my comment to this chart would be exactly the same as yours to mine a moment ago, in terms of that chart says everything you need to know. It is just heading in absolutely one direction. And I think the important thing for me here that is well, two things. One is, you mentioned the carry. You're earning for being short this pair, which obviously is helping with that trend. And the second thing is, just a kind of broader point, is just because a market has come a long way in one direction in a relatively short space of time, doesn't automatically mean that we are going to snap back to where we were. This does look, both from a technical level and a fundamental perspective, as you mentioned, with the bullish dollar narrative seeming to have run out of a bit of steam. It looks like it's got further legs to keep running down to downside.
Yeah, most definitely. And you're quite right. Nothing moves in a straight line forever. We've already seen a little bit of a low coming in around the low 1790s. That's your ballpark. That's your level you need to look at. If we come down to those lows again, test them, hold them, then maybe you think, okay, for now, we found a bit of a bottom. If we can't go down, the only other way potentially is up. And then you start to play maybe a little range, 1790 to 18, and then you go with either side of that break.
Yeah, exactly that. Well, I mentioned the bullish dollar narrative. Of course, a key component of that has been treasury yields. And I want to look at the 10-year yield once again. And this is, again, a chart that I've shown a few times now. The reason why I'm using it again is because we did get north of that 4% level last week, which I was a little bit surprised by. I thought that would probably cap things for quite some time. But we didn't get through it for very long. We got to, I think, 4.07, 4.08%. It's got to go down as a failed break, because we came back down very, very quickly indeed after the days that we saw on Friday. And in fact, into Friday's close, we then closed below this purple trend line that's been running things since kind of the start of February, when all this hawkish repricing kicked off. Now, I'm certainly not the world's biggest advocate of technical analysis, least of all when it comes to treasuries. But I do think it's important, because it just shows that the momentum is starting to turn back in the favor of bond bulls. And if you look from both a technical perspective, where we're below 4% once more and below this ascending trend line, and from a fundamental perspective, where the market has significantly repriced the Fed curve and doesn't want to look to take things any further, I think it just points to bond bulls being back in the driving seat. And for me, if you put a gun to my head, which way are the next 20 basis points, I think we're much more likely to see, and the balance of risks certainly points towards us going lower for the next 20 basis points rather than higher. And of course, if you extrapolate that into other markets, it's good news for gold, it's good news for equities, but it's bad news for the dollar as a result of that. Well, what about you, Ryan? How are you playing this one?
Yeah, I think you're right in one aspect. Where I'm going to disagree is I don't think the downside is that easy to accomplish, purely because of what we've been doing the last couple of weeks. I was surprised that we couldn't hold on to that 4%, 3.98. It was strong resistance last week. We broke it, got above, and on that Friday I was watching it very carefully, that if it got under that, then we were going to see a bit of trouble. And is it profit taking? Potentially. We've also got to look at the fact that for more passive investors, getting 5% in a 1 year yield in the US, even taking out the inflation side of things, or if they're expecting inflation to come down, we're getting rates at levels where more passive investors can park their money and earn the yield, and that particularly if the inflation is going to come down. So that might be why we don't see, or we're not going to see, a rally in yields really that significant, or if we do, They go up, they don't last and come back down, because there's people who say, I'll take that 4.25% to park my money in for a few years, a few months. Yeah, I'm happy to play that game.
Yeah, I think that's a really good point, and actually something that I didn't make the cut for the trade-off this week, but I think I did tweet the chart out last week. If not, I will do so. If you look at the 6 and 12-month yield in the United States, compare that to the earnings yield on the S&P 500, and the difference between the three is about 10 basis points, which, coming back to your point, why are you going to take the risk of holding equities when you can get the same yield in the bond market? It's the whole idea of TINA, there is no alternative, which drove the market higher for 18 months or so after COVID. Well, there's plenty of alternatives out there now. What about EURCAD, Ryan, your last chart this week?
Yeah, EURCAD, and again, another technician's dream, if you like. So this one you should even manage to grasp, Michael. This is what we have spoken about before.
There's a compliment in there somewhere.
Got to get you back for the football drive earlier. This is one we've spoken about previously, and we've got a big level up here at 146.40, 46.50. We've had a look at the downside. We've set up a very decent double bottom, around about that 142s, 30, 40 area, which now is perhaps pushing us back up towards the top. And if we get up to that high there, 146, 40, 50, very, very solid level, then that's a place that I'm going to be looking at for shorts, and unless something materially has changed. But even so, shorts up to there. If it looks like it's going to break, then switching into a long is the way to do it. And the reason I say it's a good technical play, because you can see I've highlighted there's a blue bar there going back around about the 134, 133s, an absolute dime of a level. Pretty much on the dot. You could take longs off of that, and you were sailing happy. And then more you hit it, you plan for the break. And a lot of us in our circle hit that break when it came into shorts, ran it all the way down. So this one, again, technicals coming out on top for this one for me.
No, I think it's an interesting chart. I think the thing that interests me about the Canadian dollar at the moment is, I think one of the big influences on the loonie, as it always has been, is oil. And actually, if you look at Brent and WTI, both of them were up 4% one week, we're down 4% the next, we're up 4% the following week. We've just been so range bound on both blends of crude. I know you want to get onto this a little bit more in a second, so I'm not going to steal your thunder completely. But I do just wonder whether we're going to need the range to break one way or another there to actually see a decent move in the Canadian dollar, given that other catalysts seem a little bit thin on the ground. Obviously, we've got the Bank of Canada this week, but not really expecting any surprises there. I do wonder whether this is going to be a case of actually, in the longer term, the market looking specifically for the Canadian dollar at rate cuts. Are the BOC going to be one of the first G10 central banks to loosen policy? They were one of the first to hit pause, so you could easily extrapolate from there. And if so, then that's obviously bad news for the currency.
Yeah, and obviously we've been talking about this at the beginning of the year. The crosses are going to be very important. So here we have the Bank of Canada on pause. As you mentioned, could they switch to being a bit more dovish? And here we have the ECB. We still don't know where their rate ceiling is. We still don't know where they're going to stop. So on the fundamentals, you've got to think this is a pair that's maybe heading higher than it is lower, but we trade the levels accordingly. And if we can't get through that 46.40, that's where you're short. If we do break it, it could be a decent break, could be heading up towards the 150 area. You got to try it on the long side.
Exactly that. And as you said, even I can understand that chart. With that said and done, let's get into our plays of the day. So, play of the day, dollar yen is my selection or choice this week. As I've been saying, well, throughout the whole show and to anyone who'll listen, really, I think the bear case for treasuries has run out a bit of steam, as last week proved. And I think the bull case for the dollar has run out of a bit of steam as well, as last week proved. I'm trying to look, when I've coming up with this idea of ways to play this theme in the G10 FX market. And one of the key considerations for me when coming up with this trade idea this week was, what's the best trade with easy risk management. And dollar yen stands out from a mile away with this in mind. The rally that we've had over the last kind of 4 to 6 weeks has stalled at what is a huge level between 136.75 and 137.25. Now, I know there's 50 odd pips in there, but there's the 100-day moving average, the 200-day moving average, the big figure, and the 38.2% retracement for those of you who love Fibonacci levels of the decline that we saw between October and January. That's one that I'm sure Mr. Morrow will be absolutely all over. I think the fact that we failed to break through that level and then we came down and closed below the uptrend that's been in place from January to date on Friday signifies that the bears are trying to wrestle back a bit of control. And the reason I like this is not only because it aligns with my fundamental view, coming back down to kind of the mid 133s on a first test with obviously the 50-day moving average below over the slightly longer run, but it's really, really easy to see where you're wrong. Because if we get above that 137 handle, if we start to get towards those 200-day, the 100 and the 200-day moving averages, you're wrong. Cut your risk, out the trade. You got it wrong. Move on to the next one. But I think the risk reward here favors dollar yen heading lower over the short term. Ryan, what about your trade, crude oil?
Yeah, crude oil. We were talking about it earlier, and thank you for not stealing my thunder on that one. But we've got a pretty interesting chart here because, like you said, we have got a good range working out here. We've got a range down towards what we've been calling the bid and bid area, down in towards that low 70s, 72, 73, really solid support. But on the other side, we've got a decent level around 82.50. And so for once, we've seen a good period of consolidation, good range trading. Sometimes that's all you want when you're a trader. Have some levels that work out. You trade one side, you trade the other side. We're having a little bit of a move up towards that area again. We've got an intermediate area, sort of 80.50, 80.60. Need to keep an eye on that one there. But I think similar to the EURCAD, if we get up to that 82.50, if there's nothing really changed in the fundamentals or big oil news, that's an area you want to be looking at to short. Push up there, get into a nice tight short. If you're wrong, you're wrong 80, 70, 80, 80, maybe push it to 88. Maybe switch into a long again, look for a break. If the break is significant, then we're heading up towards, perhaps 85s, even up to 90s in that instance. So, like you say, there's plenty of ways to play it. Go with a short into the level, look for a turnaround on the break, or wait for a confirmation. If we get a move that breaks through 82.50, look for a retest. If a retest holds, there's your conviction to get into a long, see where it goes from there. So what do you think of that one, Michael? Is it one right up your alley?
It is. I, at the moment, will be thinking I would rather play that from the long side and think if we break that level. But as you alluded to earlier, we must let the price decide, and we will see how things react when we get to that level. Again, that brings us to the end of another show. As always, thank you for watching. If you've made it this far and enjoyed the show, please drop us a like, leave us a comment, let us know what you think of the show, how you're trading the markets, whether you think Arsenal are going to win the league, and whether you think West Ham are going to survive. Thank you as always to Ryan Littlestone, holding his head in his hands from Forex Flow Live and Forex Analytics, for joining me. Thank you also to Kyriakos, our producer, for bringing this together as he does so brilliantly every week. All three of us will be back this time next week. It's a big week ahead. Manage your risk as you trade in the markets. Plenty for us to all watch, and I'm sure there's plenty for us to get into on the trade-off next week as well. But in the meantime, thank you very much as always for watching, and goodbye for now.